So Powell is speaking at some sort of generalized conference. He's not, so we don't know what he's going to say. He could say anything, or he could say nothing. So it's very interesting. I guess I am going to need Thinkorswim, so I'm going to have to put that back up. Dun, 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 dun. That's where you'll find me. All right. Oh, this is going to take a while. All right. It'll be what it'll be. Meanwhile, though, we have had a busy week. Very exciting stuff. Let's see if we said anything exciting on Cyber Monday. We say exciting things every day. All right. But nothing important. Oh, shoot, I'm not signed in. Very frustrating. WP. All right, so that brings us up to yesterday, Tuesday. And yesterday was busy. Actually, we should go take a look at the watch list. Is this the watch list? This is not the new watch list. Oh, maybe it is. Wait a minute. Because it took me 2 weeks to write it. It's a lot of work. It's 84 stocks. November 20th. That's about 2 weeks ago. Yep, still says in progress, but it's not. All right. So here's what's up. We updated the watch list. And let's keep in mind that, oh, it's popular, 700 things. So we updated the watch list. And hang on. And the watch list is sort of the hub of what we do. So we've always got companies that we feel strongly about that are good value companies on our watch list. And so what we want to do at any given time, anytime we feel we want to add a stock, we first look at our watch list and see what is, what's currently a good deal. So always you look at what the price is when we first started watching it, and if it's cheaper, then great. And if it's more expensive, then probably you want to hold off and wait for a better price. But like this one, ARCB, you could go right away. It's in the bottom of a channel. It's in a good place. The P is 13.84. And so we give a little description of why we like it. This is our buying premise. So we have the stock, we have the price we started watching it. It does not mean we want to buy everything on our watch list. We want to buy things when they go on sale from our watch list. And I do have to go back and fix these charts because a lot of these charts are not interactive. I have to get the interactive charts. That's an interactive chart that, or whatever you call it, self-updates. See how this one says December, right? And this one doesn't, because these don't update. These charts, I don't like these charts as much, but they do update themselves, and that's kind of important for the watch list. So I have to convert all the charts back to these. But so for APD, we were watching it at 260, now it's at 327. So obviously you're not going to want to chase it. ARCC was 18, now it's 22. Boeing was 190, now it's 158. So Boeing is on sale compared to where we started watching it, but you always want to check on the premise. Now, if something is in blue, that means that as of our most recent update, I wanted you to look at it. That's why it's in blue. When I go back, when I do the next update, I will take things off of blue unless they still apply. So anything I recently have said as of the current update, which is November 20th, is going to be in blue. So if you see this, it means it was just added, and that's where we start. So these are the new additions, are the ones in blue here. And if you see a blue comment, it says their 7-year backlog of orders is always a reason we look to invest, and they're in the LTP already. I like Boeing down here. That's a good stock. So you want to look for things that are in blue if you want to just get the stuff that's current, and that's something I'm hot on right now. But of course, if it's in blue at the beginning, that means that we just started watching it and we already like it. But just because we already like it doesn't mean you should be buying it. We like it, and if it goes on sale, we'd love to buy it. But why should we buy things that aren't on sale? Unless there's a really compelling reason that we think it's going to take off. You know, like in this case, we have a low PE, we have a strong stock. This one you might, you know, this one we add because we think this is a very good floor at 100. It's at 111, but we think 100 is a very good floor. So around here, we're pretty happy buying it. A&F surprising. It's been a long time since we've liked these guys. I said that first time I've liked them in 10 years, but they're actually sort of, you know, they're sort of catching a bid, and they're in a pretty good shape. They're not too expensive for a change. They're usually too expensive, and I like these guys. Anyway, so this one says still a strong buy at the current levels. That's very clear, right? Boeing, as I said, here's our premise. BATS we just added. Best Buy. However, the adjusted EPS of 129 beat estimates, and their 15 PE strong dividend still makes them relatively attractive. You know, and again, I'd like them a lot more if they come back to 70, but they probably aren't going to come back to 70. Barclays, we started watching them at 781. That's how it's a quick history, right? We started watching them at 781, which is down around here. Although I think it was back in 2022 that we did it. We started watching them at 781. They didn't go anywhere for a long time. And then suddenly everybody realizes how valuable they are. Now they're trading at, I think that's an old comment, frankly. At the time I wrote that, I'd written trading at 13. Oh no, it was trading at 1308 just the other day. So anyway, so we still like these guys. We like the metrics. We like everything that's coming around these guys, and they're only trading at 9 times earnings. So all this is 9 times earnings. They had problems. They fixed it, and now they're back to the point where this is only 9 times earnings. So they should be at least 15 times earnings for a good solid bank. So 50% more than where they are now. And I said, still appears significantly undervalued, but no hurry, because I don't think they're going to get pushed up suddenly. But when we have a few more earnings reports, people are going to start catching off. Blackstone Mortgage Trust, I love these guys, absolutely love them. They pay 10% or more dividend. Cheesecake Factory, significant price appreciation suggests caution, but their operational performance continues to justify the higher valuation. These are our premises. They're trading at 14x. That's honestly 18x is about as much as I'd expect out of these guys. So maybe they got about 20% to go, but that makes them a solid buy down here. Cal-Maine, they're the egg people. And, you know, it's funny because, you know, due to the demand for more organic eggs, they basically just started taking all their eggs, and you know, they told all their farmers to take, you know, like, well, let's put them outside instead of cages. And so they took away the cages, and they just get to label everything cage free and pasture raised and things like that, just by simply, like, you know, they were in a big giant barn, you know, pecking at each other all day long, or stuck together so they couldn't move and everything. Because they can move, they start attacking each other, frankly. But they change it, and they say, okay, put them outside in the pasture. And so they can take the same chickens, throw them out in the pasture, and they get the stamp cage-free organic over everything. So what a scam, but it's working fantastically for them, because it's the same freaking eggs and the same chickens and the same farms, but now they got a label on it that they can charge double back. It's a great business. I'm telling you, it's funny because all of our trade of the year picks are based on like ripping off the public and no longer, you know, it's like it's unbridled capitalism as a theme for next year. It's just, let's go back to the days of like no regulations, caveat emptor, and whatever you can squeeze out of the consumers, go right ahead. And that, but you know, those are the companies that are going to win next year. CIN's a REIT I love, and you can see Blue, CLF I love, Blue, Comcast Blue, even though they're on a run, they're still got, you know, they're only 11.4 at this price. So they should be at 15 plus also. CNH we just added. Crocs I love still. CRISPR I love still. I can't believe that they're so cheap. CVS just added them. Disney is catching, they're coming back. They, you know, look, there's a couple of things. Always, obviously, Disney is always spending billions of dollars every year on producing movies and stuff. Now, because of the writer's strike, they got really backed up. So they still spent the money, but they didn't get any movies. They didn't get any output from what they spent. So now the output is coming, and they already spent the money a long time ago. So they're going to have a nice little extra bonus haul coming off. And you always got to watch the box office. Like Moana just set an all-time record for whatever the hell, you know, Thanksgiving weekend or whatever. So you got to watch the box office and watch the upcoming movies and so on and so forth. But we already went over that and decided Disney's in good shape. Dow's in good shape. They're in really good shape. They almost made our they made our top 10. Sorry. So they made our top 10, but I couldn't 100% go with them. It was, you know, anything we can poke a hole in, we don't go with. EPD, ES we just added, EVRG we just added, Ford we like, Catalyst, Fifth Third is a good bank. Future Fuel I always like. The problem with Future Fuel is there's no problem with Future Fuel except that they constantly put out special dividends, so they're always giving away their profits, and so the profits don't build inside the company, and therefore they're like a REIT. They don't gain value even though they make steady money. But if you want to own them, they're great to own. Foot Locker, now see, if you don't, it's old, and we've had it for, you know, we had it for a while. We have it in a couple of our portfolios, but we don't see any particular catalyst, therefore no blue. FMC's in a good spot. Gilead, I love. Oh, Lilly, I just was thinking about, we need to add them. Lilly's got a couple of good developments today. But Gilead, I like. Generac, I love Generac, except they're, you know, no particular catalyst, so not blue. Gold's going to be 3,000 next year. It's going to be up, although 3,000 is only up about 10% from where it is now. Let's say it's up 15% next year. But the price of gold being up 15% is $300 more an ounce, and the $300 more an ounce for GOLD is all profit. So let's say at $2,600, let's say they're making a 50% profit on the gold they pull out of the ground. They're making $1,300 an ounce. So if they make $300 more per ounce because they're selling it for $300 more, it doesn't cost them more to take it out of the ground, but they're selling it for $300 more. That means the difference is going to be 300 divided by 1,300. So they'll make 23% more profit at $3,000. Pretty simple. So if they're going to make 23% more profit, then we can just take 23%. Then we take 17 times 1.23, and we figure they're good for 21 bucks. So, you know, that's where we should be seeing them at least next year. So that makes an easy investment. Honeywell is good but not great. IBM is good but not great. IMAX, again, it unfortunately had such a. In fact, we just cashed out. In the Money Talk portfolio, we just cashed out our IMAX because it did so well. We were like, oh, well, what are you gonna do? There's nothing left. There's barely anything left to gain. We'll get back to that in a minute, so don't worry about it. International Paper went up too much. IVZ, though, is in a really good spot. I can't believe how cheap they are. Jack in the Box, I like their expansion plan. Nordstrom, Kayla, you know, and again, I like Nordstrom. I love them, and if they got back to 15, I would love them. So they're on the watch list. If they do kind of fail here and come back down, then we're going to want them. So Kelia, again, we just added them, so we're watching them. That's what a watch list is for. KLG is that spinoff that came out of Kellogg. So we like these guys. I'd written new symbol, but I didn't put it in blue because it was put down before I decided to put those in blue. Here's KHC, also very good. I mean, that's just way too cheap for them. KMB, also added that because we want to watch them. Coca-Cola, obviously anytime Coca-Cola gets cheap, we want to buy them. So if we hit the 60 mark, that's probably a buy trigger. We already have them though, so. Leibu is a biotech ETF. This ETF underperformed its target due to inherent decay in leveraged products. So it's a tricky one to play. It's red because I'm thinking of taking it off the list, actually. Levi, always love Levi if they're cheap, and they were cheap right here for sure. Lean Forward was the old Rewalk. I think Trump is going to be a problem for them. They might come off the list. Love is Lovesac. We called this one already. We picked it up at 20 and we hit it at 40. Geez, it was 33 the last time I tried a good review. Yeah, we love these guys, but they've had their run. It's not, it's getting like, it's not so obvious. It's like, I like to buy something when it really is obvious that it's going up. Las Vegas Sands has the same problem as MGM does. Medtronic, I love them long term. There's no particular catalyst though. Here's MGM, has the same problem as Las Vegas Sands. That's a circular thing, right? Middleby makes all the commercial ovens, no particular catalyst, but I like them as a value. MP just got a really big bonus because China's cutting off their shipments of rare earth. And who doesn't want to invest in the U.S. supplier of rare earth material, especially in a deregulating environment? They're going to be allowed to strip mine all they want and go out and do whatever they want to get rare earths because Trump's going to want to have that. So they already popped, but I think they're going to be an even better catalyst for next year. And here's Moderna. I like them. They can't catch a bid. Nobody believes in them anymore. I think they're long-term a fantastic company. Metal Steel, they're also drifting very, very low. Everybody's worried about China. Nike, rightfully so, was written up red. They might come off this list because I don't see them. They don't seem to have a good plan for turning around. NLY is another REIT that I love. OLN is a good company, good chemicals. Obviously, if they go down, we like them more. Paramount, I don't know. I give up. I don't understand how they can be so low. We're getting closer and closer to the takeover, and the company's going to get bought up at $15, and they're trading at 11. And and the logic is that Skydance, who's buying them, is going to be over leveraged and cut back, and the whole thing is not really going to, until the $15 is going to be worth significantly less than 15. We are playing them to be at $12.50. So we have a significant play on these guys to come out at $12.50, and they're still at 11, and it should close in March. I don't know. I mean, it really just blows my mind. I've got the whole, I got the write-up on the logic here, but it doesn't seem right that it should be still this low. It's so crazy. Pfizer, how could you not buy Pfizer when it's this cheap? Oh my God, is this ridiculous? They're trading, this is Pfizer. They're trading at 10 times earnings. The problem people have with Pfizer is that during COVID, they made a shitload of money. And I'll show you what a shitload looks like. It's an official term. It reminds me of Art Cashin, not on camera, but when you talk to Art Cashin, that's what he would say, things like that. PFE, he was a great guy. He just died. I feel so old because I knew him way back, and it's like You know, he was old. He was 20 years older than me, but it's kind of weird to see somebody just like die. He was a big part of your early life. Anyway, so Pfizer, that's what a shit ton looks like. $31 billion. So they used to be 11, 11, 15, 9, it depends on the what kind of drugs are selling at the time, whatever. Then all of a sudden COVID came along, 21.2, $31 billion. And then the next year, they were investing in other stuff, but the COVID ran down at the same time they ramped up their investing. They only made $2 billion in 2023, but now they did their investing. They're back to 16. They should steadily be making 16 billion plus, and that's without COVID, and that's a PE of 8.8 at the moment. So at this price, $16 billion works out to a $144 billion market cap. And that's what they're making. So their PE is 8.8. It's not even 10. It's not even 9. And yes, they have a lot of debt. That is a pretty intense amount of debt, but they're certainly paying it, and they're very comfortable dealing with it out of cash flow. Look at their PE range. Their PE range has gone from the this is 20, low of 20, high of 35, low of 20, high of 42. Now their PE is 7 to 8. That's insane. They're making much more money than they made back here, but their ratios here, net income was lower last year, as I said, but they should go right back to here, and the stock is not reflecting this at all. This is a huge bargain. Now, where were we? Oh, man. Was it this one? No, I knew it wasn't that one. I'm lost. Come on, man. PhilStockWorld. There. Found it. All right, let's see. Any questions before I get back to it? Nope, everyone's good. All right. And we got another half hour still for Powell, so we're in good shape, or whatever. Procter & Gamble, who doesn't want to buy Procter & Gamble when it's on sale? Again, watch list, not necessarily buy it now, but let's keep an eye on them in case they come back. Rocket Mortgage, again, if rates go down, they're going to rocket, like they're going to look like a rocket. Restoration Hardware, again, years of massive investment. They used to be basically a bathroom supply. I mean, they used to be like fancy bathrooms and fancy kitchen sinks and things like that. Plumbing hardware basically is what they were. Really nice stuff, but whatever. Now they're like airplanes and couches and home interiors and fancy lamps and whatever. They said, what else do rich people want? Because logically, they were the luxury bathroom provider. Like every single multi-million-dollar home in America had RH stuff in it. That was the benchmark for like, is it a good home or not? And there were basically very few competitors. I mean, Kohler or whoever, everybody's got a line that's in the high end, but they had all those in their catalog, plus they had other stuff. So anybody with $1 million houses knows exactly what this is. and so the point was, though, everybody got their catalog because you bought something from them, you'd start getting their catalog, and everybody who had a multi-million-dollar home had their catalog and was on their mailing list. And so they smartly said, hey, here is when they did it. And they smartly said, hey, what else can we sell these people? And then they said, we could sell them planes, and we could sell them couches, and we can sell them lighting, and we can sell them other fixtures, and we can do this and that. And they said, oh, let's do all that. But they did it all at the same time and spent unbelievable amounts of money, basically building the same company they built over and over and over again in every different segment. But now they're done and they're ready to market, and it's paying off already, and sales are coming in. So, this is going to become a huge company. We're not going to run out of rich people. But, the P is really high right now, and they're going to expand. In fact, if we look at RH, if I can remember where, let me move this so I can see it. There we go. This I can see because it's got the line. So, if you believe in the strategy and what they're doing, they used to do. Now, don't forget, this is when everybody was bored with COVID. See, that's the thing. When rich people are bored, they order stuff and they buy things. When regular people are bored, they generally watch TV or something. But rich people, they remodel their kitchens and remodel their bathrooms. So they had some good sales 2022, 2023. This is when all the remodeling kicked in. The sales are still there, but they're spending internally. See, the sales aren't dropping off, but they're spending internally. Sales are still there, but they're just coming out of their spending cycle. So it's still going to be rough next year, but then we're going to go back to 240, and they're going to go like this again. They're going to 243 and back to 5 and 6. And currently, they're $7 billion market cap. So when sales get back to 5, they're going to look super attractive. So if you believe in the story, we're basically here. And in 2020, 5 years. In 2020, they were at basically not much. They were 200, 250, basically in that range. And in 2022, okay, so as they were ramping up from 200 to 500, 600 million in sales, they flew up to 680. Now that's way too much, because this number up here was probably like $14 billion. So basically they went to $14 billion, but they were only making 689. So they were 20x. 20x for this kind of company is high. 15x is about right. So 15x got to be realistic. And let's say they get back to 400, and 15x is only $6 billion from 400 million. So next year, if they're not going to make 400, but I'm saying 2027, maybe 400, they're going to justify where they are now. And then after that, though, that's when they can start really tacking it on. Then after that, everything is gravy. So, it's not like an immediate must-have sort of stock, but long-term, I really like them. Rio Tinto, because of China, is obviously suffering. Skechers, I love Skechers, just added them. Schlumberger, very, very cheap, especially, if Trump is derailing the move to alternate energy, Schlumberger is back in the black, and they've been doing very well, very big improvements. And also, they do natural gas, so they're going to make money in the clean economy too. Here's our buddies at SoFi, and you guys have been bored to crap of me banging the table on these guys for 2 years, and finally it's come through. It's a lot of that's what happens with value stocks, though. It's like, unless there's a catalyst that makes other people realize what the value is, you can wait a very, very long time to see your premise play out. But you got to be patient. You got to give it time. And if you check your premise and you check everything and everything seems okay, just be patient. Good things come to people who wait. Sony, of course, also catching a good time for them. They've got their film franchises. They've got the electronics, the robot. They're very, very ahead in robots compared to most other companies. And robots are going to be a big thing, because it's the body. The movement is there. They've got the body. They've got the movement. They've had remember those old robot dogs? People were paying $3,000 for these robot dogs from Sony. They were really good. And that's a brainless robot dog. Now you can put an AI into it, and now you've improved the robot like by 50%, 100%. It makes it much, much better. So they've already conquered the movement and the body for the robot. Now you've got to pair it with an AI mind, but that's not that hard. That's not the hard part. The hard part is the robot bodies, as Elon Musk has demonstrated. Simon Property Group is small guys. They already took off, so there's no blue on them because they just got a little bit high. Still like them though. SWK is a very good price down here. Synchrony Financial is what we just called our trade of the year. As you see, I wrote, this is before I narrowed it down. I said, with a PE of 8.36, Synchrony remains attractively valued despite the price appreciation. They're going up in price so fast, but that's because the PE is still 10. The price of the stock can't keep up with how fast the earnings are growing. That's a good reason to see this kind of movement. I very rarely chase anything, but I don't think this is chasing. I think that it's so undervalued. It is insanely underpriced, and that's why I like these guys. AT&T, it's AT&T. I mean, for God's sakes, I don't know why I had to tell people, I don't know why I had to explain to people why you wanted to buy AT&T when it was freaking $16. we have a lot of it in the portfolios because we just kept buying and buying. The lower it got, the more we bought. Target had a rough quarter. They're going to have inventory issues for a while, but this is certainly a good place to enter right here. TNDM, also at a good price right now, but no compelling reason to buy, so it's not blue. Trox, we like them. They go up and down a lot, but that's fine. Right now they're down. Good time to buy. Truvago. Oh man, they just took off. I always like these guys. I always tell people to buy them when they're cheap, and they just bumped up really hard. I didn't know that happened. Take Two, another REIT that I like. UH, and you're buying a REIT, and rates are going down. This is the whole thing. Everybody jumps into REITs when the rates are lower. So unless you don't believe the Fed is going to lower rates next year, then this is a great thing to jump into. UHS, nice price right now still. 150. Oh no, wait. Oh, I'm sorry. It was 150. Now it's 199. It's still a good price, 199. But holy cow. USB, very, very strong. Another bank that just the price isn't catching up to how much money they're making. Valet was our trade of the year last year, and it did not work. We picked it in November when it was down. We picked it in late November, so it was already up here in late November, and now it dropped significantly. I think we still have it somewhere. It's no longer in the money to our portfolio, but it's somewhere. It does, timing wise, there's no catalyst. The lawsuits are still hanging over their head. That was the thing. We thought these lawsuits would be resolved by here, in the first half of the year, and then it would take off. Well, one major lawsuit is resolved, but they're still languishing. And I think maybe on earnings they'll resolve it, and they won't resolve all their lawsuits, but on earnings they'll resolve their outlook, and I think that'll get them to take off finally. VTRS is ridiculously cheap. I don't even understand why they're this cheap. Verizon is also a good bet. We added them to the portfolio. Walgreens, I can't say, there's nothing blue on Walgreens. There's no definitive catalyst, but I do think this is way too cheap. I don't see this, compared to CVS's valuation and compared to any kind of logic, it's hard to say why they should still be this low. Whirlpool, we're seeing good numbers. We saw good numbers on durable goods. I am surprised that they traded down because the durable goods numbers were good. The retail sales also indicated people are buying a lot of durable goods. I think they're going to have a nice earnings and a good upside surprise. And again, lower interest is good for them. Any kind of housing market movement is good for them as well. Xerox, trading at $9 is kind of silly. They took a big impairment charge, but I like them. There's no particular catalyst, but long term, I think they're worth holding. Yeti was our trade of the year 2 years ago. Still love them. I said now 39 something, so it's already jumped up. So they're trading at 17 times earnings, but they have fantastic growth. So, you know, I mean, you look for them to be at 20x at least. So if you're looking at them at 42 now, they should go up 3, which is, let's say, 20%. So they should go up $8 from here, so at least 50. And if you know something's going to 50, you can construct a very nice options play on them to make quite a lot of money, even at 50. Dun, 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 dun. All right, let's have faith that'll turn up eventually. So that was 84 stock ideas. Don't complain that I don't give you anything. Too much of my throat, unfortunately. 84 freaking things that we just went over. All right. Wow, look at oil. How's natural gas doing? Ah! Wow, look at it. Jumped up to 305. Well, I called it a buy at 3, so there you go. I didn't get a chance to get it myself. That's why I'm angry. I was going to do it during the webinar. I forgot. All right. Well, I hope somebody got a chance to buy it. Oh, this isn't today. Silly me. All right. Oh, no. I'm sorry. It is the money talk portfolio though. So at the bottom, I think, yeah. So, so then we went back and forth looking at every single one of those stocks, and this is what we ended up with as a top 10. And we had the 2 best scorers were Cal-Maine with the eggs and AT&T. I'm sorry, not the best scores. They were higher scores, but they both had very excellent. All these guys had great scores. We had Bodie and I had a matrix of different factors we were looking at, and we gave a score to each one, and blah blah blah. And we did this for 84 stocks, and we talked about the pros and cons back and forth, and this and that. It was exhausting. It wasn't exhausting for him. He can go all night, but I get tired, so I had to call it a day. But we were doing about 10 a day, and 10 a day still took us 10 days to do it. So AT&T, the thing about the 5G, they spent obviously tens of billions of dollars rolling out 5G. All these companies. Not only that, they spent $20 billion. AT&T and Verizon spent about $20 billion each just bidding on the spectrum of 5G to use. Then they spent billions, tens of billions of dollars more putting up towers and so on and so forth to transmit the 5G and all the equipment and everything else. And then they've got to have the equipment ready for the customers to use it in their webs, because you have to have a different router and all this other stuff. And then they got to wait for the phone guys to come out and put it in their phones. It's a lot. And so still 5G is not really properly deployed by anybody. And it's interesting because it just makes me worry. One problem is no matter how fast 5G is, it's still not faster than a wired router, than fiber. Let's clarify that. It's not copper, fiber. So if you have fiber, you're not improving yourself by going to 5G. And kind of the selling point of 5G is that you don't need the router and things like that, but that's not the case. You do. There's interference, there's all sorts of other things. So it's not going to be an easy rollout for 5G. And the question is there really a need? I mean, do you find yourself waiting for web pages? Do you have a lot of lag in your daily life? I don't. I don't know how many people do. I don't hear it as a complaint very often. So, we've gotten to the point where we're sort of inventing things where there's not actually a problem to solve. So, although we like AT&T a lot, despite positive catalysts, the forecasts vary widely with competing analyst views of significant disagreement about direction. They have massive, massive debt. Also, that's a killer. Doesn't matter how much profit you have when you have $150 billion in debt. It's kind of scary. Not that the U.S. government minds, but a company actually has to answer to somebody does. And so basically, unless we're, and this is from Bodie, unless we're at least 80% confident in our prediction, there's no way, it certainly can't make the top 3. So that's where it is. So what we do is we pick these stocks and we like them, and then we say, can we poke any holes in them? And so when you see something bold, that's where we poked holes in them. Then SYF had really good catalysts, the best catalyst score we had. It had solid statistics all the way across the line. I like him, as I pointed out this morning in the Morning Post. SYF, they specialize in giving credit cards to high-risk individuals, and they're making partnerships with Home Depot and all the department store, not just retail store cards and things like that. That's what they make. That's what they're really pushing on that territory. People who are hard to get credit for, they're getting credit for, but they're doing it with algorithms that are saying, you know what, this person's credit score. See, most people get rejected based on a credit score, right? So what they're saying is they're digging beyond the credit score. They're scoring people themselves, and they're picking up all the people who they feel that are unfairly scored. So in other words, sure, you missed this payment, you missed that payment, you had this problem, you had that problem, but now you've got a job that's making good money and you're steady, whatever. They're taking more stuff into account than a real credit score does. And because of that, they're adding millions and millions of people who were previously unable to get credit cards. But those people are so happy to get credit cards, they're willing to have ridiculous late fees and things like that put on their accounts, so that they can end up going from 18% to 35% to 40%, whatever's allowed. And Trump is going to allow more. Trump's going to allow these people to charge you 50%, 60%, 100% interest on your credit cards. So they're going to make a freaking fortune. And is it nice? No, it's not nice. It's freaking evil. But they're going to make a fortune. So that's how they ended up being our stock of the year pick, because they've got all this stuff going for them. They've got this great growth, and there's a wild card there that the consumer protection people, Elizabeth Warren, that pain in the ass Elizabeth Warren, who's always on the banks and always bringing them in for questioning and asking why they need to charge these rates and so on and so forth. Well, they're going to tell her to drop dead. And she probably will, because she's going to have a heart attack. But they're going to tell her to drop dead, and the consumers are going to be completely screwed, and we'll probably reopen debtors' prisons. You may as well. We're opening migrant prisons, so we should open debtors' prisons. And it'll be really fun to be a lender, and that's what these guys are. They are that kind of lender. But what really does it for me is their algorithms that tell them these are the people who we can put the screws to, because they can't get regular credit cards. So they're happy to get our other credit cards, but they also are much more likely to be able to pay these rates. So as crazy as it is, they're picking a smart target audience, and they're doing fantastic, because if you can't go around without having any credit card at all. It's so hard. So people are very desperate to get those first credit cards, or get another credit card after they've had troubles. And a lot of people, of course, have terrible credit out of COVID, right? So for not particularly good reasons, they had their credit cards taken away during COVID, and now they're trying to reestablish themselves, so they'll go to anybody to do it. And that's us. That's what we invest in. Lockheed Martin, of course, obviously, Trump is going to be great for the war industry. whether we get active, which he always says he doesn't, but we were just as active militarily under Trump as we were under Biden. But so whether we overtly or covertly support people, and whether we actively get involved or whether we withdraw and cause conflict by withdrawing, by us saying we're not going to get involved, that allows wars to break out all over the place because we're not policing it. Everyone complains that we're the policemen of the world. Well, now you're going to see what happens when we're not the policemen of the world. And either way, somebody needs tanks and guns and bombs. And Lockheed Martin makes a lot of missiles. They make those Patriot missiles that cost $1 million, probably more than $1 million. It's pre-inflation, so they probably cost $2 million by now each. And they are the favorites of mid-range conflicts. So every day, you see on the news, right? You see 200 missiles were launched to Israel. Well, that's $400 million for Lockheed Martin. It just goes poof, and now they got to make another order and get some more. And another beloved company, Exxon, destroying the world one puff of smoke at a time. Also fantastic because of the anti-regulation. They're going to be able to frack wherever they want. They're going to be able to burn off the gases. They're going to do the LNG projects. They've got the Permian, the Appalachian Basin and the Permian Basin stuff for their oil. It's going to be fantastic, and they don't have to worry about oil flaring up in the water or anything like that. They don't have to worry about runoff. They don't have to worry about pollution, and they certainly don't have to worry about global warming because it's all okay. So everything that was negative about this stock is gone. Everything we said, well, aren't they going to be punished? Isn't there going to be that backlash? Aren't they going to have to find something else to do? Nope. And what's funny? Exxon is the smartest company because they never made a move towards clean energy. They never did a thing. They never lifted a finger. They did nothing to change with the times. And I thought for years that was crazy. I was like, what are these people doing? They're acting like it's not, like global warming is not a problem and they're not going to have to change. Turns out they're right. If it's not a problem, they're not going to have to change. Well, it's a problem, just not for them. Now, and again, here. Oh, this is another good one. This is almost so. This one, I really have to think about how bad this is. Because look, my comments really lame too. Not quite enough upside potential to give us confidence in the top three. Geo, they build the ICE processing centers and the detention centers that Trump is going to build to house millions of people. I talked about this facetiously. I said this. I compared it to when the Nazis took over Germany. If you had invested in the companies that made the concentration camps and made the trains that go to the concentration camps and made the ovens that kill people in the concentration camps, those were all good investments. Well, here you go. These are the guys building the concentration camps, and you're talking millions. We only have 2 million. There's only 2 million people in prisons now. So our total prison population in the U.S. is only 2 million people, 90% of whom are black, which is a little bad. And so but we have no room in the prisons. So these guys are going to make detention centers for millions of people. Just imagine the money. But my issue with it is not that they're not great, it's that they're speculative, because you're speculating that Congress is going to approve this and we're going to do this. We did this in World War II with the Japanese. We made internment camps. We called them internment camps back then. Now they're calling them detention centers, but it doesn't matter what you call it. It's a light prison, basically. And we put all the Japanese people in these internment camps. And it was looked back as a shameful moment in American history that we hopefully learned a lesson, would never do anything like that again. Here we are doing it again. But it's going to be a big business. I mean, look, if you're if you're going to live in a dictatorship and try to enjoy it, then you have to think of things that go along with like the policies that they're putting in. You can't, you can't complain about it all the time. If you want to make money, then say, okay, we're going to make money. And it turns out, that's why I think all three of our choices this year, Synchrony Financial is an abusive lender, Lockheed Martin is a warmonger, and Exxon is destroying the planet. These are our three finalists. These are our three finalists for the 2025 Trade of the Year. That's sad. I didn't even realize it until I looked at them this morning, frankly. I was, this morning, literally, I looked at these three trades and I was like, oh my God, these are all terrible companies. These guys they're based on being terrible. There's no other reason for their existence other than being terrible. Here's Valet. I still like them. I cannot get them off. They still hit all the boxes. And I said, despite the upside to 15, which is a 50% upside, more than 50% upside by the end of the year, the fact that they have these ongoing legal issues, it's just a little uncertain. We are absolutely going to pursue them in the long-term portfolio, but to say it's a trade of the year that we're 80% or more certain that it's going to go up, no, can't give it that kind of grade. Was Powell saying anything important? Powell. Trump said the same things privately in his first administration as he did publicly. Oh, it's a Deal Book Summit. Oh, Powell's on TV right now. We'll catch up. All right. Yeah. CNH is a good one too. Agricultural equipment looks strong and rates are coming down, so easier for the farmers to get the credit and buy their stuff. But China, unfortunately, they sell a lot in China, so it's kind of dangerous. VTRS, we love them. They're ridiculously cheap. I think they should be bought, but a lot of analysts are pegging these guys to go down and not up, and there's a huge implied decline in the stock. Everybody thinks they're overbought. The analysts all think they're overbought. I don't believe that at all. But again, because of all, I don't want to be the big contrarian here, so I'm kind of I'm letting that one lie. I really like them though, and we are going to put them in our portfolios. I mean, the fact that they're not right for trade of the year doesn't mean they're not right for our portfolios. MGM, as I said, they've got the same problem Las Vegas Sands does. China is, if it wasn't for China, I'd feel better about it, but you don't know how bad China is going to be. The American market, I feel very strongly is going to be great, but they do have a big Macau presence, so I don't really want to put too many eggs in that basket. Dow also looks promising. It's hard to say it's going to happen now. The America First manufacturing stuff, though, that's in their favor. So there's a good chance that we already have them anyway. But I mean, there's a good chance that they'll do well next year. But it's too much counting on things that haven't happened yet. So I don't like that. So as I said, we end up with our final three being Lockheed Martin, SYF, and Exxon are the final three, and that became today's post. But let's see what Powell is saying. It's just a conference, so he's just babbling on.
The background is that, as I mentioned, the U.S. economy is doing very well. We're in a very good place with the economy. We're growing at around 2.5%.
You hear this?
And inflation has come down. Headline inflation was as high as 7.2 or so. Now it's at 2.3%. And unemployment's at 4.1%, which is a little higher than it was a couple of years ago, but it's still near it's a very, very low level. And, we're not quite there on inflation, but we're still making progress. So the backstory is that the U.S. economy is in very good shape, and there's no reason for that not to continue. So we raised rates to between 5.25 and 5.5, and we held them there for 14 months. And other central banks around the world had already started cutting. We were the last major central bank to cut. And we're now on a path to bring rates back down to a more neutral level over time. But you're right, the economy is strong, and it's stronger than we thought it was going to be in September. So the labor market is better, and the downside risks appear to be less in the labor market. Growth is definitely stronger than we thought, and inflation is coming in a little higher. So the good news is that we can afford to be a little more cautious as we try to find neutral.
Well, tell me, I'm actually very curious about this, just how you think about it. Occasionally when you either get it wrong or it's not where you think it was going to go. As you said, you had a different view in September than you do now. Obviously things change, but what was it in September that surprised you? And if you could go back in time, do you think that you would have known the difference?
Well, in September, what we saw was the unemployment rate had moved up close to a 4 percentage point.
All right, so interesting, but not market moving.
Again, we held on long after other major central banks had.
No real change in the indexes. Here's what we're looking like. This is what? This is, well, I guess I can back these up a little. There you go. See, the Russell is down a little bit. The S&P is up a third. And the Dow is up 184, but like I said earlier this morning, that's all who was it? Salesforce. Salesforce is entirely responsible for the Dow's upside. So really, it's not a particularly great day or anything like that, but it is what it is. All right, so oh, now it's annoying me. And we'll see what the Beige book says. Oh, the Beige book is out. Oh man, never get a break. Beige book. Beige book, Beige book. La 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 la. Okay, who's got this job? Warren. Hey, buddy. It's Beige book time. Please compare the last two books and tell us what's changed and what that's likely to mean for forward Fed policy. The next meeting is on the 18th of December. Today is the, what did I do? Fourth. Okay, and here's that. So here is this one, open a new window, go away. Dun, 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 dun. Ooh. Here we go. Dun, 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 dun. Okay, and oops. Yes, let's keep that in mind. This is for November, before November 22nd. So, you know, they don't know anything about retail sales or Thanksgiving or anything like that. And while he's doing that, let's just take a quick look and see what it actually says. Oops. Economic activity rose slightly in most districts, 3 regions, modest or moderate growth. Economic activity was generally small. Expectations for growth arose. So this is why it's dangerous with these kind of things, because, you know, a lot of business owners, that's who you're, you know, when you're doing the Beige book, that's who you're talking to is business owners. They're going to be generally Trumpy. You can tell from the election results, and plus, obviously, business owners are going to be more likely to be Trump supporters. So the expectations are there. The activity, when you say, how are things going? Not good. But how do you think things are going to go? Oh, much better now. We got Trump in power. That's where we're at with this, with people's mindset. Optimism that demand will rise. Consumer spending was stable. Consumer businesses across district noted increases in price sensitivity is not stable. As well as reports increased sensitivity to quality. Spending on home furnishings was down, which was attributed to limited household mobility. Yeah, people are, you know, houses aren't selling. Demand for mortgages was low. Report changes in home loan demand were mixed. This is not a good report. Commercial real estate lending was similarly subdued. Context generally reported financing remained available. Capital spending and purchases for raw material flat. Sales of farm equipment were notable headwind. Is there anything actually good? Overall investment activity, several contacts, future price of equipment given ongoing weakness in farm activity. Energy activity in the oil and gas sector was flat. Demand for electricity generation grew at a modest rate because of AI. The rise in electricity demand was driven by rapid expansion of data centers that were reportedly planned to be met by investment in renewable generation capacity in the coming year. Okay, there you go. That's where we are. That is, there's really not much good about that. Let's see what Warren says. Warren says, the Beige book, subtle but important changes from the prior report. Here's a detailed comparison of key themes. Yep, see, he notes it's November 22nd, not December 4th, which is good. I like the fact that he catches those things. How do you make this go up and down? Ew, that's going to be a sloppy way to do it. All right. Okay. Economic activity unchanged, 2 modest growth. November economic activity rose slightly, 3 reporting business. Implications, the slight pickup in activity, particularly optimism for future demand, signals resilience. However, the mixed performance like manufacturing and consumer spending indicates uneven recovery, which the Fed must monitor to see if the cuts are warranted. Labor. Continued moderation in wage growth aligns with the Fed's goal of controlling inflation. Employment was flat or slightly up. Wage growth softened further, though skilled trades and entry-level jobs showed robust growth. Layoffs remained low. Caution in hiring persisted. Consumer spending. Consumer spending was generally stable, but showed greater price quality sensitivity. Stabilization in consumer spending is encouraging, but the heightened price sensitivity may reflect, see, he picks up on that stuff, which is great. May reflect weaker consumer confidence. The Fed may interpret this as evidence of constrained demand. Reinforcing our cautious approach to tightening. We're not tightening. Housing market. Stabilization in commercial real estate and mixed signals on housing demand suggests that while interest rates are supporting recovery, high rates continue to weigh on key sectors. The Fed may consider this. So that's a reason to ease. Manufacturing. Manufacturing decreased in some areas, but expanded modestly in others. Capital spending remained flat overall, with notable declines in farm equipment. Manufacturing's mixed performance highlights a fragile recovery in the sector. The stagnation in capital spending could become a headwind if demand expectations falter, warranting close Fed monitoring. Prices rose modestly, businesses reporting greater difficulty passing costs, tariffs were noted as flat. Continued moderation in price pressure aligns with the Fed's inflation goals. However, tariff concerns introduce potential upside risk to inflation, which the Fed must weigh when formulating forward guidance. Regional highlights. Improved activity were in Richmond, New York, and Dallas. Manufacturing, retail, stronger manufacturing growth. Remember we had that crazy New York Fed report with the super high numbers? If it wasn't for that, we wouldn't have such good numbers. Modest growth driven by manufacturing. Okay, weaker areas, Atlanta, housing demand deteriorated, Minneapolis. Well, you know, New York is a big area, Dallas is a big area, so it's more important that they're strong than Atlanta, Minneapolis, and Richmond. Keep that in mind. Regional disparities suggest patchy recovery. The Fed will likely consider regional variations and assessment for rate cuts. Key shifts in tone. Business contacts are more optimistic about demand growth in the coming months. Like I said, outlooks in many regions have improved, though caution persists. Tapering wage pressures are good. Persistent price sensitivity, increased consumer price sensitivity reflects constrained purchasing power, possibly limiting inflationary pressures. What this means for the Fed. Maintain a cautious easing bias, signs of stabilization, economic moderation support further rate cuts. However, the resilience. All right, so if it supports cuts, and we're going to get a cut in a couple of weeks. Monitor regional divergencies. Performance across districts indicates an uneven recovery. Tariff concerns could prompt caution in rate cuts if risks. Oh, I see. Yeah. Well, I think the Fed's got a cut now, and if they have to reverse the cut or wait a while, they'll be able to blame that on Trump and say, hey, you changed the policy. We were fine before you started messing around. Outlook for December, baseline expectations, a 25-point cut to support weaker sectors and maintain the momentum. The Fed may signal data dependency, keeping options open, particularly if inflation. The Beige book reflects early signs of stabilization, but with enough vulnerability to warrant continued support from the Fed. There you go. That was a good report. I'm exhausted. All right. There's a lot to get done. Where were we? Were we done? We weren't really done. No. So now we come down to the crux of the matter. Oh, in the Money Talk portfolio, we looked at our position. So, you know, we only took $4,390 worth of positions in our first round. That was all back on, you know, August 21st, 22nd, whatever. So that, and so from this 4,390, we now have 10,460, and the profit is 6,070. I mean, pretty easy, right? There's the math. All right. And so that's our net profit, and that's a lot. That's 100 and something, 170%, 172%. So 172% profit, and that was a credit, by the way. It's negative 670. So the net cost of the trades was negative because we sold the puts and we put some money in our pocket. I mean, so that's phenomenal on a piece-by-piece basis. So what I did is I reviewed it. Our big loser in the Money Talk portfolio was Pfizer. We lost $1,200, but you know, Pfizer's at 25. We sold the 32 puts. We think Pfizer is ridiculously cheap. So all that does for us is signal that it's a good time to buy Pfizer. It's back to the Money Talk portfolio, by the way. So all that signal to us is like, this is a fantastic time to improve our Pfizer position. Hence, we add all this stuff. We spent $6,320 on that. And what is this? This is a 20 times 7. It's a $14,000 spread, but it also has 5 open ends, and we're using that the open 5 to sell 7. So when we sell 7 calls against 20 and 15 as the back end, what are we doing? We're only overselling 2 calls. So there's 2 uncovered short calls, not 7. There's only 2 uncovered calls. First of all, that uses very little margin. Second of all, the chance of getting burned on 2 short calls is almost nothing. Especially with the rest open. So we have forever to roll these, so we can roll them to much higher than 27, and we just roll them along to higher and higher and higher strikes until we get called away. No big deal. Okay, and obviously we're offsetting with the puts. The calls and the puts can't both expire in the money. Well, actually, these can because of the way I spread it. They can be $1 in the money to each other. But meanwhile, we're not going to. So we can't give back more than $700 on either one of these. One of these will expire at no more than $700 in the money, and the other one will be worthless. So the worst case scenario for us is that one of them will be $700 in the money if they're in the middle. And otherwise, though, one side will expire worthless and they're basically even. So one side will expire worthless and the other side we're going to roll. Our expectation is that the short puts will expire worthless and we will roll the calls to a higher strike. And then we'll sell another $3,000 next month or $2,000 next month, not next month, in April. And that'll be for like probably July. And if we collect another, even if we only net 1,000, if we net 1,000 in April, and we net 1,000 in July, and we net 1,000 in September, well, actually October, let's say October, and then we net 1,000 in January, and then we go into next year and net 3,000 more, that's going to be $7,000. And I'm saying very conservatively, we only make $1,000 per time. That's another $7,000 bonus against a $6,300 spread. So that's a bonus 100% because we're selling short calls, and then we're going to make another 200% here. When we make this kind of money in these portfolios, it's not luck. We're making our luck, and we're not making our luck haphazardly. We are using the math of the option positions, and we're using the definitive fact that the premiums are going to expire worthless. If they go up, down, or sideways, they will expire worthless. And then it's just a question of how badly can you be burned on the position. And to the upside, we have no fear whatsoever. And to the downside, we've got $7,000 of calls that we're going to be protecting ourselves with, short puts and calls. So here's T. We didn't have to adjust T. Here's target. Target was another short call. It's the same thing. If we have a short put, the short put loses money. So we say, okay, let's turn it into a spread. It got cheaper. We sold the 120 puts. It's still at 129. It's still way above our bottom of our target range, but we think that target was unjustly punished, and we want to jump in before other people realize that. This is what I mean, this unjustly punished. Yeah, they had problems. They're going to take a while to work it out, but we don't mind waiting. So for now, we're just taking the straight up spread 10-10, so it's really well covered. And we're spending $12,500, which is a big spend for this portfolio, but less the $5,000 we already sold on the short puts, so we're spending $7,500. And it's a $30,000 spread, so we have $22,500 of upside. And what do we need to hit on target? 150. Where's 150? Here. In 2 years, we want to get back to 150, and that's where we make our money. And if we don't like the way it's going, what are we going to do? We're going to sell short puts and calls again. Here's Barclay. That one's on track, or it's over our target already. But we still have $6,000 to collect. So yeah, so great. I mean, for a new trade, it's only net $1,850. This is 100% in the money. It's net $1,850 on an $8,000 spread with 332% left to gain. And that spread is, see, when I do these reviews, I mean, you got to realize these are like brand new trades. Even though we already made all this money, we made a fortune on this thing already, but it's still got a long way to go because it's a 10-12 spread and they're already at 13.36. And you see what I mean about aggressive put selling like we just did with Pfizer? This is an aggressive put sale. I sold the put at the top of our range because I felt extremely confident that this bank was crazy undervalued. But on the whole, that's what I was talking about today when we talked about a methodology. On the whole, what are we doing? We're picking value stocks and then we're applying leverage. But we don't apply so much leverage. This is another mistake people make with options. We're not applying so much leverage that we say, oh, wow, we could buy 1,000 of these. You know, we could buy 1,000 spreads, not 100 or not 20. We can, you know, because they're so cheap. But they're cheap, but they also have a lot of leverage, and that leverage cuts both ways. So we buy small, sensible amounts because they're going to make a fortune. It's going to make 300%, an $1,800 investment. And I mean, now we already made $4,000 on this thing, but it's currently, because we got a credit when we started. But now it's $1,850, and it's going to make $6,000 on $1,850 if it just holds 12 bucks, way down here. If 12 bucks holds, we're going to make 332%. So, and that's on what, 10 contracts, 20 contracts? What do we have for Barclays? Sorry, probably go dizzy looking at this thing. Oh, 40 contracts. So it's 40 contracts. We have 20 shorts. We're obligating ourselves for 20 times 12. That's like they ask me that all the time on BNN. What's the risk? The risk is owning 2,000 shares for 12 bucks. It's $24,000 worth of Barclays. But we've already picked it as a value stock. We already think $12 is ridiculously low. It would be very surprising for us if they end up at 10, and at 10 we lose 2,000 bucks, and at 8 we lose 4,000 bucks. Because we're forced to buy it for 20. I'm sorry, for 12. We're forced to buy it for 12 times 20. So your risk, see, that's why it always bothers me, but you don't have time to talk about it on TV. But when they ask me on BNN, what's the risk? That's really what the answer is I'm like, you know, the risk is owning the stock at $12, 2,000 shares. But my risk isn't $24,000 unless Barclays goes bankrupt. And I think that's so unlikely, I discount it. I also think $6 is so unlikely, I discount it and say I'm not even going to consider that my risk. $8, sure. Something bad can happen. They can go back to $8. I don't think you're going to see it on this chart. Yeah, here you go. They were at $8. They were at $8 this year. Do I think they're going to go back to 8? No, I find that very, very unlikely. Here, if we look at Barclays, BCS, here they are monthly. So you see, mostly, here was the actual banking crisis. It went all the way down to 4. And this is why you never say never. But 8 held very, very well. So it came down to 6, but 8 held very, very well for a couple of years from 2022 since. 8 has been very solid. That's where it consolidated, and now it's moving up. I don't think they're going back. Now, I'm sure somebody said that back here and said, oh, they're never going back to 8 again, and they went back to 8 and even lower. But the bottom line is still, years and years later, here's 10. Years and years later, this area is still held. This is what they're worth. Even in times of crisis, this is a realistic expectation. So what do I think my risk is? I think my risk is 8. So it's going to be 4,000. Is it 4 or 2? Damn it. Keep forgetting. Damn it. Oh no, it's 2,000. We sold 20 puts. I know now. We sold 20 puts. So the risk is 2,000 times a $4 loss. $8,000 is our maximum risk. I don't find that likely. And of course, obviously, we don't have to ride it down. We can put a stop. Even in this tremendous downturn, I could have stopped it here. These are months. I could have stopped it here. I could have stopped here. I could have stopped here. I could have stopped here. Oh my God, got a hit there. But how much is this giant hit? This took a month, by the way, too. 1264 to 1074, $2 drop. Took a month, and I could have stopped it there. I don't want to be a moron and just keep holding it while it's going down. And as you guys know, when it gets to a certain point, we decide, are we going to hold it? Are we going to roll it? What are we going to do with the thing? Even if I had even if I felt stuck with it now, oh, look at it. Oh, look, we're blasting up on the S&P. Holy shit. Look at that. We're already like 6,100. So if I go to BCS, I mean, it's hard to say exactly, but let's say we had sold the $15. Let's say we had sold the $20, the $18 puts, okay? I got to find something that's trading. What is going on here? There's not much trading on this thing. So let's say the 15s, all right. So let's say we had sold the $15 puts and they're now trading at 175, right? So I say, oh, I guess we should roll them. And so we roll them and I say, well, let's see, these are 175. So what else is 175? And I go here and I see it's the 12s. So I roll 2 years out and go to the 12s. The 12s are the same price. So I've knocked $3 off. So I've knocked 20% off the price by rolling for 2 years. So I've already saved myself 20% of what I thought I was going to get hit for. But I could also say, you know what? I think 10 is rock solid at $1.10. And so all I can do is roll to 40 of the 10s at $1.10. Remember, we had sold the 15s, and those are now 175. So that would be net 1325. So we go from net 1325 on 2000 to net let's just say it's 4,000. So to net 9 on 4,000. So 9 times 4 is 36, right? 9,000. I'm sorry, 4,000 times 9 net is 36,000. And if we had stayed here, it would be 2,000 times 15 is 30,000. So all we're doing is obligating ourselves to buy 6,000 more, but we've dropped our net entry from $15 to $10. Not only that, though, we've technically collected more money because here we've collected here we've collected $4,000, and here we have 175 times 20, 175 times 20 is $3,500. So we'd actually collect $500 more and roll our strike down to the lower strike. So all we've done is obligate ourselves to buy 6,000 more shares of Barclay, but we're buying 6,000 more shares of Barclay at $9. I want to own 6,000. I want 6,000 more shares of Barclay, $6,000 more Barclay at $9. That's not a penalty to me. That's a benefit. That's like, are you kidding? Can I buy that now? No, you can't buy it now. It's not real. It's a stupid thing. And that's what you got to learn. You've got to take your emotion out of it and just look at it rationally and look at the numbers and do the math. Forget the premium. The premium is bullshit. The premium is what we sell to others. We sell the premium to suckers. That's what premium is. It's what we sell to dummies. And that's how we make our money. So yeah, we're no better deep in our hearts than Exxon or Synchrony Financial or wherever the hell else the big ones. You know, we're not nicer than those companies, okay? We are also evil bastards who are making money off of suckers who think they're going to beat us in the options game. You're not going to beat us. We're not beating us either. We're just casino operators. We're just we're letting everybody place bets on the stocks that we like. And we're letting people bet that it's going to go higher, and we're letting people bet it's going to go lower, and we just take the money and we let math do the rest. That's how this works. Okay, we're playing the smart side of the statistics. That's what Be the House is. That's what our whole strategy is. Gold, same thing. Gold went lower, and we are buying more. Not a lot lower. It's not a big change in position. look, 47.4 is -7, and then -4 is so -11 on the spread. So this spread is -11. Our target is 17. It's at 17. So we're going to take advantage and reposition ourselves to a lower strike, and we push ourselves into the 15.20 spread from the 17.22, which is a $5 spread. We move to the 15.20 spread, and we also turn it into an income producer where we're bringing in cash, and we spent $2,200, but now we're in a position that's much lower. So we're in the money, and we are going to then start selling puts and calls to make this money back. And our upside potential here is 232%. IMAX went so far over our target, it's net the bull call spread, not the whole spread. The bull call spread is net $9,600 on a possible 10,000 spread. It expires in March. We could sit on it and take the $400, but we can make a lot more than $400 with $9,600 in cash. So why sit on it? Okay, IMAX did exactly what we thought it would do. We started buying it, and don't forget we only started this portfolio October 21st. We bought it because we felt that the box office would be strong, and that when they reported earnings, I said this at the time, when they reported earnings, it's good to go into the money talk portfolios, look at the original logic of these things. I said they're going to have a good season. I said, look at the summer box office. It was good. They're going to report the summer box office here, right? July, August, September. They're going to report the summer box office here and talk about how much money they made. And then the next bunch of movies into the fall look good. And so that's going to be strong also. And now everybody's overexcited about IMAX. So let's get the hell out. We made our money. We left the short puts because they still have $1,400 of additional upside. So we're going to make, because we're taking $9,600 off the table, we're going to make $9,600 plus $1,400. We're going to make $11,000 on a $10,000 spread. We're making 10% more than the spread is worth. That's freaking amazing. So yeah, let's lock that in. IVZ is still good for a new trade. Nokia also good for a new trade, 170% potential. This is like free money, this one. And there we are. That brings us down to where? Oh, I'm sorry, that was the top 10 we just reviewed. So now we go to today. We have time? Yeah, we do. Wow. If I have voice, then we have time. Let's see. Home. Any questions? If starting from scratch, what percentage of your portfolio would be STP, LTP? We started the short-term and long-term with 500 in the long-term portfolio and 200 in the short-term portfolio, and that was because we felt very negative about the market, and this is going back a year. This is going back to May of last year. In fact, we were worried about the market. Turns out those worries were unrealized, but I still probably would do the same. I would want to have a good amount of hedging. So 5 to 2 is the ratio that we had it at. 40% of the long-term portfolio was put into the short-term portfolio. Want to have plenty of money on the side for hedging. Yeah, we could have made a lot more money if we hadn't hedged, but I wouldn't. The thing is, if we weren't hedged, I wouldn't be brave enough to put these positions on. Some of these positions are pretty aggressive. I put them on because I know that should we fail, we make a huge amount of money on the hedges. All right, so I talked here about options and strategy. Here's our whole be the house mantra. And so the top trades we ended up with were Exxon is our second runner up. So imagine it like walking with the sash, but doesn't get a crown. So and I talked about this stuff, so I'm not going to go over that again. So Exxon is looking good, and this channel, they're probably going to be respecting this channel on the low end and should just bounce around through it and then break up eventually. When Trump passes new policies, that's what's going to happen. They're going to bounce, get into January, February, they pass better legislation and it favors Exxon, and they go boom, boom, boom. And don't forget, these oil companies gave Trump $1 billion. They paid for this. They paid to get Trump in office. They paid to get these policies passed. So in the money talk portfolio, which is only a $100,000 portfolio, but we play it with portfolio margin, so we don't worry about the margin so much because it's got quite a lot. But we're selling, but still you have to respect the margin. So we sell 5 puts. We collect 52.50. We buy 10 of the spreads. They're 110, 130 spreads, so it's a $20,000 spread. And our net cost is $37.50 on the $20,000 spread. It's already $7,800 in the money. The upside potential is 16,250, which is 433%. And what's our risk? Our risk is having 500 shares assigned of Exxon at 110. So here's 110. That looks like a pretty solid support line, right? So we're risking being assigned 500 shares of Exxon at 110. We don't think it's going to get back to 110. If it starts breaking down here, we could always cut our losses and get out. So we don't think we're going to get a lot of damage from that, because even if it surprises us to the downside, this should still be a good support line for a bounce like this, right? Surprising downside, it bounces off here, came back here. We would be seeing at this point, we'd be like, thank God, let's get out of this stupid thing. That's what we do. Now, we'll regret it because then it goes like that. But meanwhile, we're like, we'd be at a certain point, we're just like, oh, thank God we got a bounce. Let's get out. It's not inactive, but because of our rules on Money Talk, we only trade quarter to quarter. So it would have to be a major emergency for me to want to trade the Money Talk portfolio if it's not on the show. Here's Lockheed Martin. They had a phenomenal run from 460 to 600, which is basically 30%, right? So it's a 30% run. You expect some pullback, but the pullback turned out to be a lot more than I would have thought. I would have thought 540 would have held. But instead of 540 holding, it actually dropped all the way back to 516. If you want to do the math on this, I would call this run 450 to 600. Okay, so that's a 150-point run. That means your pullback is going to be 20% of 150, so that's 30s. So the pullback should be a weak retrace is 570. A strong retrace is 540. That's why I would have thought that held. And then 30 more down, 510 is the strong bounce line. So if the strong retrace holds, you don't even have to worry. It's just a normal pullback. If the strong bounce line holds, then this is probably an overshoot, and you'll see what happens. If the strong bounce line fails, then you have to question the entire rally. You may be going all the way back to where you started. So really, this is a critical zone. It's a strong retrace at 540 and the strong bounce at 510. But what's this thing? This is the 200-day moving average. So this little, that's one problem with this chart is that for some reason it emphasizes the 50-day moving average the most, and it doesn't emphasize the 200-day moving average. The 200-day moving average rising and over our 510 or getting to our 510 line means this is going to be pretty darn good support. So I think it'll hold. If it doesn't hold, I'd be seriously concerned, and we'd have to figure out what's wrong with Lockheed Martin. But I like it here. I think this is a great entry point. That's why, obviously, that's why it's here. And in this case, we spent net 505050 on a $15,000 spread. Now, by the way, my logic on this is if it goes well, because we don't know it's going to go well, if it goes well, we're going to be a little more aggressive and we'll add to it. And we might widen the spread. We might spend money to widen the spread. We might sell a short call or a short put or a combination. There's money to be made here once we figure out what their comfortable channel is. Right now, it's a little rangy and a little scary to play. So we're just taking a basic spread. And notice I sold the 400 puts. That's a mile away from 510. 400 is below, 400 is off the chart. So we sold the 400 puts. I seriously don't think that's going to happen. I would find it almost impossible to believe. But if 460 fails, we're going to bail because we don't want to get stuck with these things at that price. So we'll if 460 doesn't hold, we're going to probably get very worried about those short puts. But meanwhile, I feel pretty good about this trade. I think this will hold. The 200-day moving average is rising. That should give it a kick back up. Then we'll make sure of our bounce lines to watch what it does, and we'll be in good shape. And then lastly, we're in Synchrony, and I put this little complaint ad here, a meme or whatever. Is that a meme when it's like that? And it says Synchrony exorbitant interest rate increase to 34.99% with a 39.99% penalty APR. And this is a warning to cardholders that freeze your card. Don't cancel it. If you cancel it, it hits your credit. But if you freeze your card, it's you're just not using it. Good advice, frankly. But again, it goes back to the thing. It's the audience has to have the ability to get another card. Otherwise, you've got to have it. You've got to have something you can use. Just pay the balance at the end of the month, and don't, God forbid, don't ever not pay it, because they're going to start bleeding you through the nose. But we like Synchrony here. They just make more and more and more money. And in this particular case, we're going to obligate ourselves for 1,000 shares selling the puts. We're buying 15 of the spreads. It's net $67.50 on a $30,000 spread, and our target is 70. That's our target 2 years from now. This is their trajectory, and if we get to 70 2 years from now, we are going to make 344%. We're going to make $23,000 on 6,750 cash outlay. And what's our risk? Our risk is owning them at 65, aggressive or fairly aggressive for the short puts. We don't think they're going back. We don't think 55 is realistic, and if it is, we're going to lose $5,000 bucks. We would stop it somewhere around here and take it off the table. And that's it. So that's our trade of the year, because the trade of the year is the stock most likely. I don't need the stock to go up. It's already in the money enough that we're gonna, we would make a fortune. We don't need it to go up, but we just need it not to go down. And so I believe that the chances of Synchrony being below $67 a year, 2 years from now, is slim to none, like probably less than 5%. So I don't see a lot of things that's going to get in the way. The Fed is lowering rates. Powell just said this at this conference. The Beige book indicates that we're on track for still needing to lower rates. Trump's coming in office, or he's not going to put any regulations on the banks. You don't have to worry about Elizabeth Warren spoiling Synchrony's party or anything like that. We can just go ahead and put the squeeze on all these people who need credit and charge them through the nose and take all their money. So fantastic. Let's do that. So that I feel so bad. That's our trade of the year. I'm sorry, I'm a bleeding heart liberal. It's very hard for me to actually it's very hard for me to actually back this stuff. It's like it just goes against my brain. But anyway, so like I said, if you're gonna live in a kleptocracy, you better be ready to be a kleptocrat. So that's what we're doing. And these are picks for a kleptocracy. We're gonna enjoy it, and we're gonna make a lot of money. And if we make a lot of money, we'll be part of the club. We can go to Mar-a-Lago. We can hang out and toast champagne all night and all that. So we'll have a good time. All right. So thank you for joining us. It's going to be a very interesting 2025. I've just given you 85 good stocks to 84 good stocks to play with, and I'm giving you our tops. So let's see if we can make something out of it. Okay. Have a good day, everybody, and thanks for coming.